You have a growing business, but know there could be a large future tax bill. You may want to consider an estate freeze to help save these future taxes. But what is an estate freeze, and why would an estate freeze help? My name is Brent Van de Kerkhove. I'm a financial advisor at RGF Integrated Wealth Management. Let's talk estate freeze. An estate freeze can shift the future growth of your business and its tax liability to a trust or your heirs. This strategy can lead to significant tax savings by reducing the amount of money subject to capital gains tax upon your death or the sale of your business. An estate freeze may also give you more options for succession planning, as it provides more time and flexibility to think of who to transition your business to. Let's work through an example of how this could work for you. We'll take Dale. He's the founder and owner of a successful real estate services business, currently valued at $5 million. He's married, has 2 kids, and expects his business to grow significantly over the next few years. Dale's concerned about the future potential capital gains tax that would be due on the future growth of his business when he eventually sells it or transfers it to his kids. So he considers an estate freeze and compares the 2 scenarios. So if he doesn't do an estate freeze, the current value of his business is $5 million, determines the future value in 10 years to be $15 million. So the capital gain is $15 million. His capital gains tax, if he sells at that point in time, is $5.3 million. Now, if he does an estate freeze, he freezes the current value of his business by doing the following: converts his shares into preferred shares valued at $5 million. Then he issues new common shares to a family trust. These new common shares represent the future growth of his business. The future value is $15 million. The value of the preferred shares is $5 million, and this remains with Dale. The value of the new common shares is $10 million, and this is held by the trust. Since the value of his new preferred shares is locked in at $5 million, Dale's capital gains tax is $1.74 million, which is the value owing at the time of the freeze. When Dale eventually sells his preferred shares, he'll only pay taxes on the value that was locked in. If he dies while holding these shares, his estate would face approximately $1.74 million tax bill on this locked-in value. The new common shares, which have grown to $10 million, are now with the trust or his heirs. Any tax implications on these shares will depend on when and how they're disposed of, but they'll benefit from the growth without having to pay taxes on the initial $5 million that Dale locked in. By freezing the value at $5 million, Dale has effectively shifted the future growth and its tax liability to his heirs or trust. Now, without the estate freeze, the tax liability, $5.3 million. With the estate freeze, tax liability, $1.74 million. In summary, an estate freeze provides tax savings and more time and flexibility for business succession planning. Now, the estate freeze is a complex transaction that should only be implemented in consultation with experienced lawyers and tax professionals. When we build financial plans for clients, we often work together with your trusted lawyers and accountants to ensure the right strategy gets put in place. Please reach out if you think this could be of help to you.